Welcome to Forex Naija, the podcast that breaks down global currency trading for young Nigerians. Whether you're a student, a side hustler, or just curious about the Forex world, we've got you covered. From the basics to real strategies, we're here to help you trade smart, build wealth, and stay woke in the money game. Before we go further, subscribe and like the video. Let's dive in.
Hello guys, welcome to Forex Naija. It's your host again, Maxwell. So today we'll be talking about how to predict the market. So we have different ways to predict the market, which is the technical analysis and the fundamental analysis. So we'll have to start with the fundamental analysis. The fundamental analysis is a way of looking at the forex market by monitoring economic, social, and political forces that may affect currency prices. So let me explain this to you guys. This fundamental analysis is kind of a way whereby the news that we get from different countries, and which every country has their currency, so the news we get from those countries affects the price movement. That's what determines how the price will move, how the market will move for that day or for that period of time. So the major kind of news that affects this market price more is the CPI, and other wars can also affect price. Election, holidays too affect price. Like all this, during holidays the price might not move well. Why? Sometimes when there are news about a particular country, if it's a bad news or a good news, you see either the markets will rise or it will drop. So let me just explain it. Maybe something about a news about USA. Let's say there was a growth in their economy, or any good news about the country. So you see that the US dollar will become stronger. So any pair you are trading against, the US dollar will start dropping, and there is a way the news will be very, very high. It will be very volatile. So you see some spike in candlesticks just moving high, like going high and going down. So that's all about the fundamental analysis, but I'm not really a top fan of fundamental analysis, though I still use it, because sometimes you can just merge it with your technical analysis. It will just help you. Most times it helps your technical analysis move faster and all. So now we'll be going to the technical analysis, which I'm big on, which I really use to predict markets and all that. So technical analysis is the study of historical price action in order to identify patterns and determine the possibilities of the future direction of price. So what this means is just like you go to your charts. There are some patterns the market will make before, and they will keep repeating that pattern. So technical analysis will help you go through it. Then you see how price has been moving. That's like my last video, I was talking to you guys about the trend. That's the bullish trend and the bearish trend. So the technical analysis will help you know if the market is bullish, or where to buy, where to sell from. If the market is ranging, it's just in one place, ranging, not moving, not going up, not going down. So to stay off the market. Or if the market is bearish, to know where you enter the market from. Or if it's bullish, still know where to buy the market from. So I'll be giving you this, like my simple trading strategy I use, like for beginners, but I will not go too deep into my strategy. Maybe in the next video we can do that. Okay, so like I said I will not be going too deep into this strategy, but I will just try to explain so easy as I can. So let's start by looking at this chart. So when when you look at this chart, you notice that the market is giving a downtrend kind of pattern, because you can see that is giving us a this is a higher high, then this is a lower low, because the market already broke structure here. This, like, they also call this change of character. So you can see since when the market broke this area, you will know this is now a downtrend, though it was giving a bullish trend before the market changed. You can see here higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So the market was supposed to come here and start going up, but it broke this place. So we call this a change of character, or some people call it market structure shift. So whatever you want to call it, but just know that whenever a price break a demand zone, this is what we call it, this demand zone. That's the first candle before a break of structure that caused the break of structure. This is what we call break of structure. When markets breaks the previous higher high or previous lower low, we call it break of structure. Then this first candle, either this, some people use this red one, that's this red candle, some use this only this blue one. So in my own case, most time I like using this blue candle here. So this is called the demand zone, where I'm always looking to buy from. And not only that, you just look for a demand zone and just start buying. There are other things you look out for also, which is the fair value gap, that's the FVG, and liquidity also. So as you can see now, according to what I was saying earlier, there was a change of character here. That's to show that market is telling you that it's starting to go down. So whenever you see this kind of change of character, now you know that okay, I'll start looking for buys. And as you can see here, when price came from this side, broke this structure, then it went up, then down again, and as you can see, the downtrend continues. You can see it here, the downtrend continues. So after all this has been happening, then when I get to this side, let's say I'm around somewhere here, the market is just here. So after I've seen that okay, this market has changed character, so we are already on a downtrend, so what I'll be looking for is only buy and sells. I'll be looking to sell either from here or from here. So that's what I'll be looking at. I'll always be looking to sell either from here or from here. So these are the place I'm interested in to sell from, here and this place. Those are my demand, those are my supply zone. We call it, this is called the demand zone, this is called the supply zone, where any place you are entering a sell from is called the supply zone, and any place you are trying to enter a buy from in the SMC is called the demand zone. So here at the supply zone, I'll be looking to sell from. So as you can see, the market broke this first one, but when it got to the second one, because of all this liquidity, all these are liquidity. So after markets broke this my demand zone, though I think I didn't take this sell, or I took it. I think I took this sell, but this one, it's stop loss, and this entered. So you can see the supply zone, from the supply zone, because there was already a break of structure. As you can see here, there was already a break of structure, and all these are liquidity. This is the supply zone the market was supposed to sell from, and you can see what happened immediately. The market sold immediately, and again you continue selling because there's no change of character yet. I can only think of buying if the market comes from this place to break this new high here. But if the market does not break this new high, I'm still looking to sell. But if the market breaks this new high, I'll be looking to buy. So as you can see, looking from another demand zone, supply zone again to sell from, and you see the market got to the supply zone and started going back. So there are different ways to enter trade. We have like two different ways to enter trade in this SMC strategy. We have the aggressive entry and we have the confirmation entry. So let me just explain the aggressive entry. The aggressive entry is just you, like now maybe I saw this demand zone and I'm looking to enter, so I'll just put my pending order without waiting for any confirmation. After doing that, I put my pending order here. You can see it's stop loss 10 pips, because I did not wait for confirmation. But looking at the second one, another aggressive entry, but this time around it went down our way to it take profit. So let me now show you guys what a confirmation entry means. So in a confirmation entry, now we are already on a 1 hour time frame. So during the confirmation entry, you have to go down to, let's say 15, or mostly it's 5 minutes. No, it's better you use the 5 minutes, but let's just use the 15 minutes time frame. So what you will do here now in this confirmation entry is that the same way you are seeing the higher highs, higher low, lower high, lower low, you still look at the market trend, but we call this one the internal structure. That's in every time frame they have a structure, just the way the 4 hours has structure, the 15 minute has. So you look at this internal structure also. You see it's giving us a bullish kind of trend. It's giving us a higher high, higher low, higher high, higher low, keeps going up like that, and like that. So now you can see that the market now has hit your demand zone, and your supply zone rather. So now you just wait till there is a breakdown here. If there's no breakdown here, you are not going in. Unlike the aggressive entry, immediately it's your support or demand zone, you just go in. But this, you're not going until you see a breakdown here. So when you see a breakdown here, so then you wait for a confirmation. You look for your order block. This breakdown here has given you confirmation that the market is trying to change trend now. That means this sell is about to happen. The sell you have been waiting for here is about, because if you can look from here, the market has been giving us higher, this an higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. You can see that the market is bullish till it got to this side. Then what happened? This is a change of character or market structure shift. The market has shifted to the downside. You know the market is about to go down. Then what will you do next? The next thing you do is to look for your supply zone where you'll be selling from after this market structure shift or the change of character. So after doing that, then you can now place your sell limits and put your stop loss slightly above this high. You can see that the you are just risking just 7 pips. It's not even up to, unlike you putting the aggressive entry, you'll be risking about the aggressive you'll be risking about 24 pips. So now with this confirmation entry, you just risking just 7 pips to take profits. You can see 12 risk to reward ratio, but I don't advise that. You should always take profit at least at 3 risk to reward ratio, or let's say 4 risk to reward ratio. Just take like almost about 50% or 60%, because this 29 pips is, for me, it's okay for me. Then I leave the rest to run down to our lower low. So that's just how to predict the market. That's how I enter my trade every time. So let me try and see if there are any other examples I can use to do this. Let's see, do I have any example? Let's see any other examples. Okay, so same thing happened here. A change of character happened here too. Okay, I've explained the selling side. Let's look for buy. Okay, if you can see this. So if you look at the 4 hours time frame of this, you see that there is a demand level here from the daily time frame. So you can see what happened here also. You can see the change of character that happened. There's a demand level coming from this side, coming from here. The demand level from here. So in my next video, I'll be explaining that fully well for you. That's like the top down analysis. So you can see the downtrend. The market was still on a downtrend. This is like a lower high, lower low, lower high, lower low, lower high, lower low. So now you see this is a break of structure to the downside, and then a change of character. This is the previous high that was taken out. Previous high was taken out. That's the lower high was taken out. Then you can see a change of character, and you look for your demand zone, and after that you buy. You can see how the market moved. Though this gap was because of this move happened on Friday, October 3rd. So this gap was a result of the opening of the market. So I'll be explaining all that to you later on with time, so you can see what happened to the upside. So guys, I think that will be all for today. So in my next video, I'll be going more in on the SMC strategy, be teaching you guys about the demand zone, fair value gap, liquidity, and all that. So don't forget to subscribe to our channel and like the video. Thank you very much.